Picture this, a classified folder labeled The Bet Cantor Fitzgerald. Next to it, a digital screen flashing, The Signal, Fourth Turning. This isn't just about tariffs, it's about the collision between crony capitalism and global re-industrialization. We are witnessing something much bigger than a trade dispute. We are watching the sovereign state reassert power, while financial power places bets around its outcome. And when sovereign power and financial leverage collide, history doesn't whisper, it pivots. An executive order imposes tariffs. Revenue flows in, markets adjust. Then, the Supreme Court intervenes. A 6-3 ruling blocks the action. Refunds may be owed. Uncertainty spikes. Look at what this represents. Not just policy reversal, but institutional friction. The executive branch asserts economic force. The judiciary pushes back. Markets don't fear tariffs. They fear instability inside power structures. Because when branches of government clash, capital asks one question: who is actually in control? Now we move deeper. Corporations pay $100 in tariffs. Legal uncertainty arises. Refund claims trade at $20 or $30. Someone buys those claims. If the ruling strikes tariffs down, payout $100. That's 3x to 5x upside. If upheld, worthless. This is not corruption. This is liquidity arbitrage. Volatility creates a marketplace for information, and those closest to power monetize first. That's the Cantillon effect. Proximity to monetary and sovereign authority creates asymmetric advantage. The policy becomes the trade. The same individual can exist in two domains, as a sovereign policymaker and as a financial operator. The sovereign role, design tariff architecture. The financial role, position around its consequences. This isn't conspiracy, it's structural overlap. And when policy and capital intersect, the system reveals its leverage points. Power is never neutral, it is always positioned. Here's the key insight. Tariffs are not the event. They are the symptom. This is sovereign power asserting itself in a system that has been dominated by financial globalization for 40 years. And that assertion triggers resistance. Not because tariffs are inherently destructive, but because they threaten a model built on frictionless global capital flows. This is the beginning of a structural shift. Enter the fourth turning. The world is shaped by four power centers: the sovereign, leverage through laws, sanctions, regulation; the financial complex, leverage through capital flows and liquidity; the military complex, leverage through destabilization and security guarantees; the tech complex, leverage through platforms and data control. Each has a different objective. Each exerts pressure differently. When they align, growth accelerates. When they conflict, volatility explodes. Right now, alignment is breaking. On one side, the sovereign. Goal, national stability and industrial base. Tool, tariffs and regulation. Loyalty, the nation. On the other, transnational capital. Goal, return on investment and efficiency. Tool, arbitrage and volatility. Loyalty, none. Capital has no flag. Financial power profits from volatility regardless of national outcome. This is the core fracture. For 4 decades, the United States exported dollars and imported goods. Asset prices surged. Financialization expanded. Meanwhile, the real economy hollowed. Manufacturing shrank. Supply chains moved offshore. The dollar's dominance funded consumption instead of production. It worked until it didn't, because dependency on foreign production creates strategic vulnerability. The industrial rival pursued a different strategy: export goods, accumulate gold and commodities, build infrastructure, control supply chains. You cannot fight the rival you depend on. This is the strategic paradox. If your military hardware relies on imported components from your adversary, you are not sovereign. The U.S. borrowed money from abroad to purchase weapons built with foreign parts to counter foreign power. This is not just irony, it's fragility. Globalization optimized for cost, not resilience. When geopolitics intensifies, resilience becomes priceless. From financialization to production, from paper to things. Tariffs are not taxes. They are industrial forcing mechanisms. They create friction. they raise costs, but they also incentivize domestic production. The transition is violent because the previous model was extremely efficient. Efficiency and sovereignty are not the same. You cannot have a dominant global reserve currency and a dominant industrial base. A strong dollar makes exports expensive. Cheap imports hollow industry, but weaken the dollar, and you threaten reserve status. This is the Triffin dilemma, and it is the central trap. There are only three paths forward: austerity, politically impossible; fiscal dominance, inflation pays the debt; devaluation, strategic reset. The most realistic path: fiscal dominance, moderate inflation, managed rates, slow erosion of real debt burdens, not collapse, controlled transition. One theoretical solution: mark gold to market, revalue sovereign gold reserves, recapitalize the balance sheet without explicit default. This isn't fantasy, it's historical precedent. Gold is the ultimate neutral reserve asset. In systemic transitions, neutral assets gain power. The official story: punishing rivals, fair trade, protectionism; the strategic reality: system reset, currency management, re-industrialization. The financial complex resists because it profited immensely from the old system. Transitions are never smooth. They are contested. The paper economy is breaking. The pivot to real things is violent. Volatility is not random. It is the mechanism of wealth transfer during structural change. Don't watch the political theater. Watch capital flows. Sovereign power asserts itself. Financial power positions around it. This is not a crisis, it is a realignment. And in every realignment, wealth moves. The question is not whether change will occur. The question is, will you understand it early enough to position before the shift completes?